Imagine walking into a restaurant with a 50-page menu. Every single page has dozens of options, complex descriptions, exotic ingredients, and varying prices. You're starving, you just want a solid meal, but instead, you are hit with massive decision fatigue. If you make the wrong choice, you'll ruin your night and waste your money. This is exactly what it feels like when you open your first brokerage account. You are staring at thousands of individual stocks, mutual funds, ETFs, cryptocurrency options, and complex financial instruments. Everywhere you look, some self-proclaimed guru is telling you to buy the latest tech stock, dive into options trading, or predict the next market crash. It feels like a full-time job just to avoid losing your hard-earned savings. But what if I told you that the wealthiest, most successful investors in the world don't do any of that? What if the secret to building multi-million-dollar wealth isn't finding the next hidden gem, but doing almost nothing at all? Today, we are stripping away the noise. We are going to build a complete, bulletproof investment portfolio using only 3 simple index funds. This is the exact strategy championed by legendary investors like Warren Buffett, and it is designed so you can set it up once, automate it, and let it build wealth for you in the background while you live your life. By the end of this video, you will know exactly what these 3 funds are, why they work so well together, how to choose the right allocation for your age, and how to automate the entire process. Part 1. The myth of the active investor. Before we look at the 3 funds, we have to address a massive lie that the financial industry has spent billions of dollars trying to make you believe. The lie is simple. To make good money in the stock market, you need to pay an active money manager, or you need to spend hours every day analyzing charts to buy and sell stocks at the perfect moment. Think about it. Wall Street makes money on fees and transaction volume. Every time you buy or sell a stock, or pay an expensive advisor to manage your portfolio, someone else gets paid. They want you to believe investing is highly complex because it keeps them in business. But let's look at the actual data. Every year, S&P Dow Jones Indices releases a report called the SPIVA Scorecard, which compares active fund managers, people with Ivy League degrees, supercomputers, and millions of dollars in research, against a simple, unmanaged index like the S&P 500. Year after year, the results are shocking. Over a 15-year period, more than 90% of professional active fund managers failed to beat a basic, low-cost index fund. Let that sink in. The absolute smartest minds on Wall Street, working 80 hours a week, cannot beat a passive basket of stocks that you can buy in 5 seconds on your phone. If the professionals can't do it consistently, why should you try to day trade your way to wealth? This is where passive investing comes in. Instead of trying to find the needle in the haystack, we are simply buying the entire haystack. An index fund is a single basket of stocks that tracks a specific market index. If the index goes up, your fund goes up. You don't have to guess which companies will win or lose. You simply own them all. By accepting the market's average return rather than trying to beat it, you actually end up beating 90% of the people who try to outsmart the system. Part 2. Fund number 1. The engine of growth, total U.S. stock market. Let's build the portfolio. The very first piece of our 3-fund puzzle is the engine that will drive the vast majority of your wealth. This is a total U.S. stock market index fund. When you buy this fund, you are buying a tiny piece of virtually every publicly traded company in the United States. We aren't just talking about the household names like Apple, Microsoft, Amazon, and Tesla. We are talking about mid-sized companies, small regional banks, and up-and-coming healthcare firms. Usually over 3,500 companies in a single fund. If a brand new startup becomes the next giant success story 10 years from now, you don't have to worry about missing out. Because you own a total market fund, you automatically own a piece of that startup as it grows. The biggest advantage of a total U.S. market fund is its simplicity and its incredibly low cost. Traditional mutual funds can charge you 1% to 2% in annual management fees. That might sound small, but over 30 years, a 2% fee can eat up nearly half of your potential investment growth. Total market index funds, like Vanguard's VT-SAX or its ETF equivalent VTI, have expense ratios around 0.03%. That means for every $10,000 you invest, you only paid $3 a year in fees. You might ask, why not just buy the S&P 500? The S&P 500 is great. It tracks the 500 largest U.S. companies and makes up about 80% of the total U.S. market's value. But a total market fund gives you that extra 20% exposure to medium and small companies. Historically, these smaller companies can have higher growth potential. By choosing a total market fund, you get maximum diversification across the entire landscape of American business. This fund is the core of your portfolio. When the U.S. economy grows, your wealth grows. Part 3. Fund number 2, the Global Shield, Total International Stock Market. While the U.S. market has been an incredible wealth generator over the last century, keeping all of your money in one country is a risk. This is known as home country bias. We often think the U.S. will always dominate the global economy, but history shows us that market leadership rotates. There have been entire decades, like the 1970s and the 2000s, where international stocks outperformed U.S. stocks. If you only own U.S. companies, you are missing out on some of the largest, most profitable businesses in the world. Think about the products you use every day. You might drive a Toyota, buy furniture from IKEA, use Samsung electronics, or drink Nestle coffee. None of these are US-based companies. That brings us to our second fund, a total international stock market index fund. This fund tracks the performance of thousands of companies outside the United States, spanning both developed markets like Japan, the UK, Germany, and Canada, as well as emerging markets like India, Brazil, and Taiwan. By adding an international index fund, like Vanguard's VTIAX or its ETF equivalent VXUS, you build a global shield around your wealth. If the U.S. economy goes through a period of stagnation or high inflation, your international holdings can help stabilize your portfolio. You are no longer betting on a single country. You're betting on the progress of humanity as a whole. Part 4. Fund number 3. The Shock Absorber, Total Bond Market. If our first two funds are the engine and the shield, our third fund is the Shock Absorber. This is a total bond market index fund. To understand why we need bonds, we have to look at the relationship between risk and reward. Stocks are volatile. They go up, but they also crash. During a major recession, it is not uncommon for the stock market to drop by 30%, 40%, or even 50%. If you are 22 years old, a stock market crash is actually a good thing. It means stocks are on sale, and you have decades to wait for them to recover. But if you are 55 and planning to retire in a few years, a 50% drop in your portfolio could force you to delay your retirement indefinitely. This is where bonds come in. When you buy a bond, you aren't buying ownership in a company. Instead, you are lending money to an entity, like the U.S. government or a major corporation, in exchange for regular interest payments and the return of your original investment when the bond matures. Because these payments are contractually guaranteed, bonds are far more stable than stocks. A total bond market index fund, like Vanguard's VBTLX or its ETF equivalent BND, holds thousands of high-quality U.S. government and corporate bonds. During the stock market crash, bonds typically hold their value or even go up as investors panic and look for a safe place to put their money. Having bonds in your portfolio gives you peace of mind, prevents you from panic selling your stocks at the bottom of a crash, and provides a steady stream of predictable income. Part 5. The magic of asset allocation. Now that you know the three funds, the big question is, how much of each should I own? The mix of stocks and bonds in your portfolio is called your asset allocation, and it is the single most important factor determining your long-term investment returns and your day-to-day peace of mind. Your asset allocation should be based on two things: your age and your risk tolerance. Let's look at three different life stages to see how the three-fund portfolio adapts to your needs. Portfolio 1. The Young Aggressive Growth Portfolio, ages 18 to 35. If you are young, time is your greatest asset. You have decades of earning potential ahead of you, meaning you can easily ride out short-term market crashes to capture long-term growth. The allocation: 70% total U.S. stock market, 20% total international stock market, 10% total bond market. The strategy: this portfolio is heavily weighted towards stocks to maximize the compounding effect. The 10% bond buffer is just enough to keep you grounded during a downturn, while 90% of your money works in the global stock market. Portfolio 2. The Moderate Balanced Portfolio, ages 36 to 50. As you reach peak earning years and start thinking about protecting your progress, you want a balance of high growth and safety. The allocation: 60% total U.S. stock market, 20% total international stock market, 20% total bond market. The strategy: by increasing bonds to 20%, you reduce the overall volatility of your portfolio. The portfolio will still grow significantly, but a market crash won't hurt nearly as much. Portfolio 3. The Wealth Preservation Portfolio, age 50 plus. When you are nearing retirement, the goal shifts from growing your wealth to making sure it lasts. The allocation: 40% total U.S. stock market, 15% total international stock market, 45% total bond market. The strategy: with nearly half of your portfolio in high-quality bonds, you have a reliable stream of fixed income. Even if the stock market goes into a multi-year bear market, you have enough stable assets to live on without being forced to sell your stocks at a loss. The beauty of this system is that it is completely customizable. You can adjust the sliders to fit your personal comfort level. If you lose sleep when your account balance drops, simply increase your bond allocation. If you want to maximize growth and don't mind a bumpy ride, tilt heavily toward the U.S. and international stock funds. Part 6. How to set it up and automate it. The final, and most crucial, step of this strategy is execution. A great strategy on paper is worthless if you don't actually put it to work. Fortunately, setting up a three-fund portfolio is incredibly simple and takes less than 15 minutes. First, you need to choose a brokerage. Stick to the big, established, low-cost options: Vanguard, Fidelity, or Charles Schwab. All of these platforms offer their own versions of total U.S. market, international, and bond funds with near zero fees. Next, you need to choose the account type. If you want to save for retirement and get tax advantages, open a Roth IRA or a traditional IRA. If you are already maxing out your retirement accounts or want access to your money before age 59 and a half, open a standard taxable brokerage account. Once your account is open, buy your three chosen funds in the exact percentages you decided on for your asset allocation. But here is the real secret to building wealth: automate it. Do not log into your account every week trying to decide if it's a good time to buy. Instead, set up an automatic monthly transfer from your checking account directly into your brokerage account, programmed to automatically purchase your three funds. This takes emotion completely out of the equation. When the market is up, your automatic transfer buys fewer shares. When the market crashes, your transfer buys more shares on discount. This is a proven investing principle called dollar cost averaging, and it completely removes the stress of trying to time the market. Once a year, Log into your account for 10 minutes to rebalance. If your US stocks did incredibly well and now make up 80% of your portfolio instead of your target 70%, simply sell a little bit of the US stock fund and buy more of the international or bond funds to bring your allocation back to your target. That is it. No daily tracking, no checking stock charts on your lunch break, and no stress. You have built a diversified, low-cost, global investment portfolio that runs entirely on autopilot. Conclusion. Take action. Building wealth isn't about finding a magic stock or timing the market perfectly. It's about consistency, low costs, and patience. You now have the exact blueprint to set up a portfolio that works for you, not the other way around. If you found this guide helpful and you're ready to start building your own wealth on autopilot, please hit that like button. It really helps this video reach other people who are tired of the financial noise. And I want to hear from you. Which of these 3 funds are you starting with, or are you already using a 3-fund strategy? Drop a comment below and let me know. Finally, if you want more deep dives into simple, effective wealth building strategies without the jargon, make sure to subscribe and hit that notification bell so you don't miss our next video. Thanks for watching, and I'll see you in the next one.